Finding stocks analysts love isn't all that difficult. You just have to know where to look. Here are 3 stocks to buy that analysts love. TJX Companies. The off-price business model is priceless. S&P Global. The index company's growth is taking a slight pause. It will return. Intuit. The company's data makes its AI platform hard to beat. Let's dive in. Here are the under-the-radar 3 stocks you didn't realize analysts love. Welcome to Timely Investment Research. One place where you can get ideas on the best stocks to buy is to review the top stocks analysts love. At the beginning of 2023, Investors Business Daily published an article discussing the 9 stocks analysts thought would deliver the best returns based on 12-month target prices. Of the 9, only Dish Network is down year to date, and it's off by more than 57%. So, there's something to following the pros' recommendations. A quick finviz.com screen of S&P 500 stocks tells me that there are 63 with an average analyst recommendation of less than 2. Lower is better in this situation. The worst score is 3.5. There are 2 stocks in this lowly category. Approximately 387 are between 2.0 and 3.0, with 53 above 3.0. The companies I'm after are those in the group of 63. To make things interesting, I'll select from 3 different sectors and select 3 different share price categories. 1 below $100, 1 above $500, and 1 in between, with a median target price at least 5% higher than the share price. Number 1. TJX Companies. Representing the consumer discretionary sector, TJX Companies has a recommendation rating of 1.80 and a share price under $100. The company's share price jumped by more than 4% in mid-August after reporting results that were much better than expected. On the top line, its revenue was $12.76 billion, $310 million higher than analyst expectations, while on the bottom line, it earned 85 cents a share, 8 cents above the consensus estimate. Despite it rarely delivering massive annual gains, TJX is one of those stocks analysts love as it provides enough meat on the bone for investors to keep coming back over the long haul. Year to date, it's up nearly 16% and 39% over the past year. After the discount retailer reported its second quarter 2023 results, Barron's reported that Barclays analyst Adrienne Yeh was very complimentary about its business. TJX's report is a testament to the strength of the off-price model in a consumer-slowing backdrop, wrote Barclays analyst Adrienne Yeh in a note to clients. Inventory remains plentiful in quality and quantity, and consumers' pressured wallets are seeking value via the off-price channel. There is no question that TJX's off-price business model is an enduring one that will continue to generate profitable growth. Of the 25 analysts that cover its stock, 19 rate it overweight or buy, with a $99 median target price. Number 2. S&P Global. Representing the financial sector, S&P Global has a recommendation rating of 1.70, according to finviz.com, and a share price between $100 and $500. The company best known for its S&P indices business is having a decent year in the markets. It's up more than 17% year to date, about 103 basis points ahead of the index. Of the 23 analysts that cover its stock, 21 rate it overweight or an outright buy, with a median target price of $450.50, 14% higher than its current share price. The last time I called on S&P Global was in July. The financial stock was one of 3 names that analysts generally liked. Nothing's changed in that regard. Well, not entirely. S&P Global reported its second quarter 2023 results a week after my July video. They were decent, if not a thing of beauty. Revenues rose 3% on an adjusted basis to $3.1 billion, while its operating income was $1.43 billion, 2% higher than second quarter 2022. At the midpoint of its guidance, the company expects revenues to grow 5% in 2023, with earnings per share of $12.45. That's 11% higher than in 2022. By hook or by crook, CEO Doug Peterson will continue to grow S&P Global profitably. Number 3. Intuit. Representing the tech sector, Intuit has a recommendation rating of 1.80 and a share price over $500. The company's share price jumped by more than 4% in mid-August after reporting results that were much better than expected. On September 6, Intuit launched its first artificial intelligence product, Intuit Assist. It is part of CEO Sasan Goodarzi's $20 billion bet on AI and big data that he made almost the day he became the company's chief executive in 2019. Fortune's Jeff Colvin recently reported that Goodarzi said, "At the end of the day, there are certain decisions you have to make. And the decision I made was, as a team, we're going to bet the company on data and AI." Between TurboTax, QuickBooks, Credit Karma, and MailChimp, Intuit has a treasure trove of data from more than 177 million customers. Good data is critical to good AI. That puts Intuit heads above anyone else when rolling out AI-focused financial apps. While the decisions made by Goodarzi back in 2019 involved risk, the CEO considers not taking action would have been equally risky. "We are at the beginning of the journey with AI," Goodarzi told Fortune. "In the next 5 to 10 years, it will create new economies and destroy some economies, will create new experiences, fuel new company growth, and make certain companies go out of business." In fiscal 2024, July year-end, Intuit expects to grow its revenues and earnings by double digits, hence why it's one of the stocks analysts love. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.